Jason, Wellington is saying the market is fragile. We're walking on thin ice. The next crisis is going to be worse than the last.
Didn't you write about this a year ago? So the hard part about this article, one, I like that it was shorter than yours, so it was a nice quick read. But two is you and I couldn't agree more violently kind of with this article. So I'll be happy to take the other side of this and try to steel man some other sides of the argument just to be contrarian for the sake of this video.
Well, let's walk through the points and see where we do agree and disagree. So the first point that Wellington made was that the supply of liquidity seems to be shrinking in the market. And they looked at this really in two ways. The one was looking at the individual stock level, looking at the S&P 500, and looking at sort of the daily average size of the best bid and offer. And what you see when you look at this graph is a decrease in size over the last decade. This is intriguing to me, and it's something a lot of people have pointed out, that sort of headline liquidity has been decreasing. But I wonder if this is really just a function of perhaps the rise of dark pools, or potentially increasing homogeneity among high frequency traders. And so if you have, for example, 20 high frequency trader groups a decade ago that's converged maybe down to a major 5, those 5 may be in a place where they don't have to keep as much size in the order book at any given time if they can execute with greater speed. So this might just be indicative of not necessarily markets being more efficient, but technology being potentially more capable and not necessarily needing orders to sit resting on the order book as much as they used to.
Exactly. And let me caveat that it's like we're arguing against ourselves. You and I both have products that take advantage of this lack of liquidity in the environment. So I'll just, start with that caveat. But I think you started to nail on it. And the part of the problem is the measurement tool. And people are using the order book and the bid ask, spreads, or like the amount of bids and offers at any given time. And that the problem is that's only the liquidity you're seeing. So you don't get it both ways. People like to say, well, a lot of these algorithmic or high frequency trading firms are going to pull their orders when liquidity dries up. But you're not seeing on the other side, it's a red queen principle, that people executing their orders are using different high frequency styles of spoofing orders, iceberg orders, et cetera. And like you're saying, if you have that ability to execute orders more quickly, you're not going to have them sitting on the order book. And so I think that's more of a part of it than people realize. Is like, for example, we don't execute a lot of orders, but when we're using an algorithmic trading desk to make sure we get the best order execution possible. And like I said, they're using all of those tools and techniques developed by the high frequency trading firms to battle them on the other side to make sure we get the best execution. And they're not going to leave those sitting on like a level 2 order book.
I think that's right. And we do much the same. We outsource a lot of our execution to agency desks that specialize in building these execution algorithms, specifically in a very adversarial way to compete against what high frequency traders are doing. They're trying to get us the best execution. High frequency traders are trying to generate the most return. It may simply be that sitting, to your point, on a level 2 order book provides too much information to your counterparty. That said, their second graph was much more intriguing to me, because what it showed was, I believe it was in S&P 500 E-mini futures, the size of the best bid and offer. And unlike what we saw at the stock level, where it was sort of this perpetual decline, we saw a very sudden decrease right after the February 2018 Volmageddon episode, where the XIV, inverse VIX ETF, blew up. And after that point, you see a sudden step down in the level of size being bid and offered. And that to me is much more curious and something I don't have a good explanation for. Well, hey there, just your friendly editor here. Wanted to pop in and mention that there was a great discussion on Twitter going on about this article after we recorded the video. And a couple really important and interesting points were brought up. One of which was that when we look at E-mini futures, the actual tick size hasn't changed over time. What does that mean? Well, if the tick size is 25 cents, then that's going to be a much larger percentage change when the S&P 500 is at 1,000 than when it's at 4,000. So if we're constantly only looking at that top bid and top ask, what we're effectively doing over time by focusing just on those levels is looking at a smaller and smaller and smaller percentage of the order book. So we're actually looking at less and less depth as the index goes up. And so that might be one reason we're actually seeing the decline in size. The second really interesting point was brought up by Ben Eifert at QVR, who mentioned that when we look at the graph, it might actually be that 2015, 2016, and 2017 were outliers. That the underlying trend is indeed there, that headline liquidity is getting worse. But when we think about how market makers operate, their amount, the size that they're willing to offer on the bid and the ask, is going to be a function of their estimate of forward volatility. When markets are realizing really low volatility like they were in 2016 and 2017, it allows them to potentially offer more size. And so that period might actually be the outlier in a more long-term structural trend and decline in market depth. Okay, back to the video. Let's jump to point two, where they're discussing that the supply of liquidity is now seemingly more correlated with the actual level of volatility. That as volatility goes up, the supply of liquidity is going down. What's your take?
Well, part of that, as you and I both spoken about, is you have volatility targeting on massive scale. So any sort of vol targeting fund, as volatility picks up, they're going to degross or deleverage their books, in which we saw en masse in March of 2020. What I also wonder about is what is the extended duration of that move? Like we saw in March, you have a lot of people degrossing or deleveraging their book with volatility targeting. But once they hit their vol levels they're looking for, when they've degrossed enough, they're going to flatten out any sort of trades. And so did that start to happen in that third week of March in 2020? You also had options expiration, which set off, it limited a lot of the gamma dealer hedging, so that was, there's different circumstances where people think, what potentially could have happened in that third week of March. And so that's part of it. So if I want to talk about, once again, the other side of that is, what about all of these hidden orders with structured products, right? As Americans, we tend not to think a lot about structured products, but you have enormous amount of structured products being issued in Asia, even more growing in Europe. And actually, they're actually moving on to US shores now, selling these structured products. And part of the structured products trade is these banks are not necessarily hedging a lot of that exposure to start the product. As the market starts to go down, they're going to really start to hedge their book, but it tends to be like a bell curve because they have an absorbing barrier of whatever that knock-in option point is, whether it's negative 30, negative 40% out of the money. So they'll start to hedge and they'll be buying into all those hedges. But once they hit that absorbing barrier, they're putting it back to the customer. So now they're going to be selling into a lot of that pressure. So if that's kind of hidden off the book, so to speak, we don't know how much that's going to affect the markets as volatility picks up. Could we see an actual expansion in actually contracts traded, because you have enormous amount of structured products sitting off the books that needs to come in, hedge, and then de-hedge their books in this kind of unique bell-shaped fashion that you have right around their absorbing barriers?
There's really two things here that were very curious to me. The first is that this lines up with some data I've seen when you compare plotting VIX versus something like the Chicago Fed's E-mini futures market depth estimate. Again, we go back to this very curious Volmageddon February 2018 break, where prior there was a bit of a correlation between VIX and how much depth there really was offered in S&P E-mini futures. And then post Feb 2018, not only did that depth dramatically decrease, but the sensitivity of that depth seemed to increase dramatically to the VIX level, to the point where, you know, correlation isn't causation, but you have to wonder, perhaps it's liquidity going down that's actually driving VIX up, right? Another potential cause here of why we might be seeing this actually has to do with the way market structure works today. And again, I want to go back to high frequency traders. And I don't want to say there's necessarily anything nefarious. I know a lot of people talk about high frequency traders pulling the plug when markets get uncertain. But I think we have to go back to this picture of what we used to have as a diversified cohort of market makers has now become a much smaller group of primary liquidity providers. What you're likely to get as that group sort of coalesces is models that are a lot more similar. As human capital gets passed around these firms, you would expect the models to converge to something very similar. And so in a crisis, they might all behave very similarly. On top of that, these firms are not charities. They're run for a profit. If markets get weird, you would expect them to step back, reduce the amount that they're offering or bidding, and widen out their bid-ask spreads, which is going to hurt liquidity as a whole. But I think even more than that, we need to recognize that these parties operate on a tremendous amount of leverage, right? For me to be able to make markets, I need to post collateral, borrow a huge amount of money, and that's what I'm going to use. And when that collateral itself is the securities on my book, and those securities become more volatile, I might not be able to borrow as much capital. And therefore, I am going to be prohibited from actually making markets as deep as I could in a non-volatile environment. In fact, if you go back to March 2020, it slipped under everyone's radar, but Virtu, one of the largest market makers out there, actually put out a press release saying that they were trying to raise, I think it was $400 million, simply so they could keep making markets. It wasn't for lack of want, it was for lack of capital. And so when we have this structure that market makers are operating on a huge amount of leverage, that leverage is enabled by collateral that, as it becomes more volatile, allows them to provide less liquidity, you get the potential for a very nasty pro-cyclical relationship.
So we have a lot of liquidity takers. You know, we alluded to this idea of vol targeting strategies, and those will be your risk parity or your CTA trend followers of the world. They're going to put positions on or take them off based on the volatility of markets, whether they're using, you know, ATR and a trailing volatility signal for putting on position sizes in CTAs, or, you know, risk parity is trying to figure out the level of volatility between their stocks, bonds, and their other exposures. And what happens is, as we said in March 2020, especially if you have an endogenous liquidity event that's triggered by an exogenous event, you're going to have, as volatility spikes, these people are going to be degrossing, deleveraging their book, and this leads to a rush for the exits in a fire exit type of scenario, and those have increasingly become bigger and bigger parts of the market. It's hard to really put a finger on how big risk parity or risk parity like vol targeting strategies have become across tactical asset allocation portfolios. And then the rise of the CTA universe, you know, people have become, you know, larger and larger asset gatherers within CTAs. And part of that is, you know, they're becoming billions or tens of billions in size, but they're also moving out into more financial products than just their core holdings of commodities. And so therefore, when you have this volatility, you know, spike and then the degrossing of the books, you're seeing it much more in their financial products. And this is creating much more of these endogenous cascades, as you would say, in a liquidity cascade. I'm curious if they would look at it any differently than that, or?
No, and I think this chart does a wonderful job of just sort of showing that all of these products operate a little bit differently, whether we're talking variable annuities or risk parity or CTAs. They all have their different nuances. But headline behavior is, as markets sort of converge towards one primary risk vector, and we track that with, say, VIX, as VIX spikes, we see a decrease in the estimated position size among all these target volatility strategies. And similarly, I think just as dangerous, as vol decreases, leverage goes way up, the position size goes way up. So you get this sort of situation where, as markets are more stable for longer, it breeds potentially more internal fragility because all of these players are getting more and more levered. And so, as you said, any sort of exogenous shock can create this endogenous waterfall of selling pressure from all these people who are going to be demanding to get out the door at the same time. As we just showed, all the supply is disappearing. So you get this huge asymmetric mismatch between people who are willing to provide liquidity and people who are systematically demanding it. Let's talk about chart 4. This one is a little more difficult to grok at, I think, first light. But what they're effectively showing here is vol of vol. And what we can see is that over the last 20 years, vol of vol has been going up dramatically, which we can interpret almost as the rate at which we're going from low volatility to high volatility environments and then de-escalating back from high vol to low vol is faster than it's ever been. All right, past Corey, I'm gonna have to stop you right there. So before we get into this graph anymore, this is why it's important to trust but verify. A whole bunch of us on Twitter went round and round in circles trying to replicate this graph. Actually, the good folks over at Wellington reached out to me eventually to explain how they actually created it. And the process works a little something like this. They took daily returns, and they then took those daily returns and calculated a rolling 20-day standard deviation. So basically rolling 20-day volatility. At the end of each month, they took that value, and then what they did is a little bit weird. Using those end of month values, which represent sort of percent volatility values, they took month over month percent changes. They then looked at 24-month periods of those percent changes and calculated the standard deviation to get the graph that was represented here. Now, here's my problem with that, is that when you're talking about volatility, percent change, in my opinion, isn't really the right transformation to take. Because what we're looking at is saying say for example, a volatility level of 5% to 10% is a 5 percentage point change, but it's a 100% change. That would be equivalent to saying going from 20 vol to 40 vol, also a 100% change, but that now it's a 20 percentage point difference. And so in my opinion, the right way to have done this would have been to actually not take percent change month over month, but actually just the difference month over month. And that ends up resulting in a very different looking graph, one which doesn't quite support the argument as well. Despite my opinion, I do want to thank the folks at Wellington for reaching out and working through this with me. They still stand by the graph as being a meaningful interpretation of vol and vol, so I'll leave it up to you, the watcher, to make your ultimate determination. And if you're still watching here, don't forget to like and subscribe. Thanks. So of course, like every article written by an asset manager, this is a thinly veiled sales pitch for investment strategy. As they point out at the end, Wellington says, the alternatives team notes that with this view, it might be a good idea to start implementing risk mitigating strategies like market neutral approaches and that sort of thing. What's your take? I mean, should investors change the way they invest?
Oh man, talk about teeing me up. Yeah, I've said before, I think that the last 20 years has been a hyper-financialization of markets. Part of that is becoming much more derivatives, moving out the risk curve, creating these kurtosis-like curves. And so to really hedge your book, you need something that has an asymmetric payout like put options. You need the convexity on the other side. So if endogenous liquidity cascades can lead to much more violent sell-offs, you need something that has an equally violent ballast to the portfolio. And this is what you and I believe in with buying that convexity of put options. And I referenced this earlier with risk transfer services or harboring an inventory of liquidity is essentially what you're doing when you're buying puts. And when everybody needs liquidity the most, you're that provider of liquidity. You're sitting on that inventory, and so you can rip their faces off technically. But yeah, so that's as we always talk about, that's that's how you should really set up your book, is that a lot of the market neutral or historically defensive strategies may not provide enough of a ballast in a violent sell-off, especially if liquidity disappears. We're going to enter free fall much faster than people are accustomed to.
My last question for you is, typically when rumor becomes news, that's the time to sell. Is Wellington writing about this the sign of a top of this thesis?
Phenomenal question. So my fear, as always, is that even volatility can be in a bubble. And this is what we saw in 2010 to 2012, is that everybody wanted an arc after the flood. So they all start buying insurance post 2008, 2009. And so therefore it gets bid up, but then your strategies can do well in that environment. But this also belies having a truly well-diversified portfolio, because if volatility trading or long vol strategies or tail risk strategies are now in a bubble, that's fine. You have other assets on your book that are taking advantage of the inverse of that bubble. But also implicit in this paper or your paper is the idea too that we can't call tops or bottoms, and that you almost have to have these negatively correlated asset classes on your book, because if it's a kurtosis curve, you don't know if we're going to be in that low vol environment or that high vol environment, and the endogenous liquidity cascade leads to those air pockets. So it's almost impossible to time the market as you shift from risk on to risk off and back again. Now make sure you like, subscribe, and hit that notification bell so you never miss one of these amazing episodes.